Welcome to The Way to Build Wealth. I'm Ethan Bloch, and I'm teaching you how to build some wealth on a Thursday. Welcome to the show. And as we always do on Thursday, thirsty? A Thursday. And today, like I said 2 weeks ago, we're continuing trying some boiling sodas because I was taken off guard how good the first one was, black cherry, and today we're trying a root beer, boiling. We link up some boiling sodas down there so you can check them out on your own. Wow. Let me try it once more. So I'm actually extremely surprised that this soda actually, this root beer by Boylan, it sucks. I don't know how else to break it. It's just not. Let me try it once more. Can you hear that? The steps? Okay, cool. It's just not a good root beer. I'm extremely disappointed. The black cherry was kick-ass. And I don't even like black cherry, but I like that soda. I like root beer, but I don't even like this soda. I don't know. You should try it on your own. Don't take my word for it. Let's get into the show. Today I'm talking about bonds. And you may be like, Ethan, why are you talking about bonds? You're always like, hey, best way to build wealth is stocks. Why are you talking about bonds? I'm talking about bonds because even though I've said so many times that stocks are the best vehicle to build wealth or for building wealth, you can't completely ignore bonds because bonds also provide you some security and some diversification. Why do they provide you diversification? Well, you see, bonds are basically debt or pieces of debt that either a government or a local government or a corporation issues, and they have very different rights than stocks do. Now I'm trying to think, should I get into that right now or should I wait for a second? Dun, 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 dun. Let's get into it right now. So basically, let's say you own bonds of Coca-Cola and Coca-Cola goes bankrupt. Let's say you also own stock. We'll make it really easy. Stock and your friend owns bonds. If Coca-Cola goes bankrupt and you own the stock, you are the last person to get paid in the totem pole. If you own bonds, however, you actually have a lien, potentially, on their assets. And the first people to get paid are the courts and the lawyers, and the third or fourth or second people to get paid are the bondholders because they own the debt of the corporation. So that's one thing that gives you a little bit more security. And the second thing is bonds pretty much give you a guaranteed income stream. For example, if Coca-Cola sells you a bond, a 10-year bond for $100, bam, with a 10% coupon rate or 10% interest, every year Coca-Cola is going to give you $10. And then at the end of 10 years, they're going to buy your bond back for $100. And nothing will affect that $10 per year unless Coca-Cola goes bankrupt. You're guaranteed to get it. And bonds are graded. You probably have heard Moody's, S&P, Fitch. These are all bond rating agencies. And they look at a bond and they look at the company and say, this bond is rated AAA or AA or BBB, whatever it is. And those give you, or should, judging by the credit crisis, they weren't so great on some of those CDOs, but they should give you an idea of how safe, those bonds are. So that's a whole lot of bond talk. Let's talk about how you can own them or the best way to own them. Today on the show, I've only been talking about corporate bonds for a reason, because next week or the week after, I'm going to talk about government-issued bonds or local and city government municipal bonds. Today I'm talking about corporate bonds, and the best way to get in the bond game is to own bond index funds. The best way, seriously. Bottom line is the average person doesn't have time to go and seek out individual bonds issued by individual corporations that buy them. If you can do that and you know what you're doing, more power to you. And way later on in the show, we're going to talk about how to do that. But for now, we're covering the basics, how to get set up and start building wealth today. Bond index funds. You own a bond index fund, you own a bond index fund by Vanguard, Fidelity, or Schwab, and you can own the entire U.S. investment grade bond market. Everything. Why would you want to do that? Because you guarantee yourself the average return of the bond market and you pay extremely low cost to do it. And that brings me to a quote. I think this is pretty good. This is again from the Little Book of Common Sense Investing by John Bogle. We reviewed it. We'll link it up down there. So this is a quote from when he's talking about bond index funds. He says, nonetheless, Smart investors will save themselves lots of money and substantially improve their returns if they apply the same principles of broad diversification, low cost, no load, minimal turnover, and long-term investing when they select fixed income funds. Fixed income, just another word for bond, because the coupon interest rate is fixed. I'll let that man have the last word. I think I covered, I should say this as well. So it's a pretty regular idea that the older you are, the more bonds you should hold, because bonds are less volatile, and like I said, they guarantee you income. The younger you are, the more stocks you can hold, because you don't need the money tomorrow. A rule of thumb that I think he mentions in this book is you take your age and you turn it into a percent, and that's the amount of bonds you should own in your portfolio. So if you're 30, 35, 35%. If you're 25, 25%. Now I think that's a little too conservative. You know, you can almost have that number and still be all right, because as I've said so many times, stocks are the best way to build wealth. And the only reason we're talking about bonds is to get a little bit of diversification in that portfolio of yours. We're going to talk a lot more about diversification tomorrow. That's all I got for today. Me, Ethan Bloch. Oh, I almost left the whole part out. I'm so glad I caught myself. In combination with this episode, like I did with the S&P 500 and the total stock market index funds, I put together a sheet of offerings from Schwab, Vanguard, and Fidelity of total bond index funds. It breaks all the metrics down for you, expense ratios, minimal initial investment, etc., etc. I'm going to link up the sheet down there. Use it to your advantage. These are great resources I wish I had when I started investing. Me, Ethan Bloch, helping you build some wealth.